Hello and welcome back to this video number 4 about how to trade like a pro looking at historical returns. So what does a pro have first? On top of having a professional setup to invest or trade, like outside capital, an IT support, access to financial research, direct access to market, very powerful risk control tools, being able to look at risk on versus risk of understanding, and so on and so on. In reality, professional investors like fund managers, proprietary traders, family offices have an investment mandate. A pro has to follow different investment criteria. So after looking at factual numbers in video 1, where we saw how badly retail traders do, and knowing the importance of having an investment process based on top-down, overlaid with bottom-up to recapture all investment ideas that could have disappeared from the top-down filtering, and having active trading strategies, we know how important an investment process with a trading plan is. The video 2 was mainly about discovering the different asset classes from stocks to money market instruments in order to have a balanced portfolio and to benefit as much as possible from asset diversification. In video 3, emphasis was on GDP and how central it will be in our investment process. GDP will tell us a lot about recent economic trends, about the economic cycle, about inflation, and central banks' possible interventions. In this video, I would like to start with the importance of defining as much as possible your investment mandate, like the pros are doing. Here, all is about having realistic expected returns based on your investment universe and historical returns. In this video, we will look at historical volatility. A mandate can be defined by its expected returns, through the targeted returns and theoretical downside, in other words, the risk-reward. Secondly, a mandate can be defined by its universe of investment. A mandate clearly defines in which asset or assets the fund manager or trader can invest and in which regions. Here, as you all know, some US investors can only invest in US assets or in US dollar. Same could be the same in Europe, with investors, let's say in France, that cannot be investing in the French market, or Germans only in the DAX. Third point, a mandate can be defined by the type of strategy or strategies followed. Typically, investors are using different investment strategy like growth, value, for examples. Then, a mandate is explained by its time frame. And here, what is important is what returns could investors expect from such a mandate based on historical returns from similar time frame. Finally, we need to look at its risk management or risk parameters. This section will be well documented with gross exposure, leverage, net exposure, concentration by region, single name, sectors, market cap, max drawdown, and that will be in a further video. So here, this is an example of a mandate that I had from 2005 to 2008 when I was working for the hedge fund. So here, as you see here, from 2006, equities in Europe included UK. So that was my universe. The target was absolute return. So I've been doing absolute return for more than 15 years now. And what is important in the mandate is saying, the low volatility and reduced correlation to market development as a whole. This is an absolute mandate. Again, universe equities in Europe, expected returns, absolute returns. So I'm not lying, I've been doing that for years. Here, this is an example of a mandate with all the criteria that you should be ticking. So at the close of each day, or at the close of each month, this is the rules that your fund should be following. So the first one is telling you no more than 10% exposure to any one user for investment and money market instruments. Another one will be no more than 10% of the NAV of the fund to be invested in funds. You can go through all of them. Obviously, that will vary from one fund to another. What is your mandate? At the end, you don't have any mandate. What you need to do is an absolute return mandate. So you need to make money. Your only target as an investor should be to make money in any market condition. That is the goal of the 4x4 process. The first thing, let's look at the positive versus the industry. As you have no constraint on your mandate, it is an absolute return mandate. That is quite different from a fund manager that has, for instance, monthly report where he needs to show exposure at the end of each month, of each quarter, of each year. And if the fund is holding cash for too long, trust me, it will experience redemptions. Investors will say, oh, this fund manager doesn't need that much money because he's so cash, and then they will withdraw money from their funds. So even if patience is a virtue, traders will need to produce P&L, and to get capital will always be compared against peers or other desks. Secondly, what are the negatives for you versus the industry? If not prepared, your infrastructure will be not as good. Knowledge and experiences are keys, meaning you want to have people around you with such experience. For me, the biggest negative is there is no one, like an investor withdrawing money after a bad performance, or your trading floor boss cutting your position to stop you on your risk management or when your performance is wrong. So you need to have a strict management rules. At the end of the day, you are on your own. So here, the idea is to start with a perimeter like a learning curve. Otherwise, you will get lost. The last point is the most important thing. At any time, especially when investing on your own, from day one, you need strict risk management rules. It sounds a bit cliche, but trust me, Rome was not built in a day is very valid for trading or investing. Let's have a quick look at my experience through all those years and through my process. I started in 2000 in Paris with a mandate of 10 stocks on the SBF 80 index, which is a small and mid-cap index. So my mandate here was mainly based on outperforming the index. After a few weeks and being successful, my bosses decided for me to go from 10 stocks to the whole French market. After a few months, I started to trade European markets like Benelux, Germany, Spain, and the US. Then, in 2004, I moved to London and my book increased massively with a longer time frame. And then I started to trade FX, futures, and options. Still, it was a long-only mandate. Then, in 2006, meaning 6 years after I started, I went into the long-short fund with an absolute mandate. So I was running both a long-only mandate and a long-short fund. Then, in 2008, I wanted to move from the hedge fund community into prop trading. So I went and moved to prop trading with an absolute mandate, no regional or asset classes constraint. So it took me 8 years to go from a very small book, very small universe, to a non-constrained book, long short in 2008. So the meaning of this spreadsheet is to tell you there is a long learning curve and you need to take your time. After looking at this long learning curve, it sounds natural that you need to know when to take risks. First, based on risk-reward assumption. For macro fundamentals analysis like GDP, as we've seen in the previous video, and micro for single names that we will see later with risk return, market conditions like risk on versus risk off, looking at equity, bonds, yield curve, bond versus equity, earnings estimate, valuation, leading indicators, and so forth, and comparing implied volatility versus historical volatility or the VIX index. Here, it is about putting the odds in your favor by doing a deep analysis. Secondly, knowing when to take risk is based on existing P&L and its recent trends. As an investor, you should know when a market is working well for you. As pros say, P&L does not lie. In that sense, a successful investor always analyzes his trades ex ante. It is important to keep history of your trades, P&L, exposure, and how it works. You can keep a trading journal. We will do a video later on this topic. To better know when to allocate capital to strategies, the Kelly criterion could be very helpful. That will dictate your overall exposure, net exposure, gross exposure, leverage, and concentration, based again on two things: your risk-reward assumptions and your existing P&L and its recent trends. So the risk, what about the myth versus the reality? As widely accepted by many people, risk-taking decreases with age. So households, for instance, take less risk in response to decreasing financial security over time. The belief behind this view is that older investors have less time to recover from potential losses incurred with risky investment. But empirical studies have different conclusions, and in reality, different factors are in play. As developed countries have an aging population, this will have an impact on asset allocation and asset prices, and how individuals will manage their own money. And that's the same case for you. This is the same reality. If you are in your 20s, your 30s, your 40s and 50s, how much capital you have and how much capital you can allocate to different asset class. Here, our asset allocation depends mainly on our risk tolerance and appetite. Tolerance will vary greatly depending on your existing level of wealth and hedge. Your risk tolerance is not static and could change over time. And here, this is maybe one of the struggles that as an investor, you'll be facing, as your risk tolerance will move from one period to another. Here, the risk appetite versus the tolerance. As I've said before, your risk appetite tolerance will greatly impact your mandate. And the factors that might impact your risk appetite are your age. Again, if you are in your 20s, you might take more risk than someone that is in his 50s. Your gender, your marital status, if you are divorced, if you are married, let's say if you are married, you get more chances to be looking for something stable. Education, your financial knowledge. Obviously, the more you know, the better you'll be prepared. The income, the wealthy and lower income, and its stability. So some people that have very little money are eager to take massive risks just to change their lives. Here, risk appetite has to go hand in hand with clear risk management rules. To be successful in the long run, adopting hard stop-loss policy will be crucial. So let's look at this formula, which is known as the 120 minus the age formula, which should give you your stock allocation. Here, you need to take 120 minus your age. So let's say you are 20, your normal allocation into stock should be 80% and 20% bonds. If you are 50, that should be 50-50. At the end, this allocation is very theoretical. Keep in mind, it is harder as retail investors to have access to bonds, at least single names. So at the end of the day, it's very, very hard to get access to single name bonds, and what you'll have to do is probably be buying ETF, which are more general. As bonds are much harder, less liquid and less transparent. Again, that means you'll have to have exposure to ETF. But the meaning of that is, what is my knowledge about stocks and bonds? The 60-40% allocation. The 60-40% allocation is about 60% in stocks and 40% in bonds. This is a very well-known allocation. Again, this allocation is very theoretical but well-known and was advocated for many decades. So if you were going to university 20, 30 years ago, in Finance 101, you will start the allocation with a 60-40% portfolio. And most of your calculation will be based on that. It is in reality not always easy to implement due to capital restriction and limitations to some markets. For example, the bond market is not as transparent or liquid as the equity market. But let's look at the possible return. 60% stocks with an average return, 60% times 9% roughly, that gives you 5%. 40% stocks, Average return will be 40% with 3.3% return. So that gives you 1.3%. So the total return should be around 6.6%. So this is something that we have seen in the last 30 to 40 years. But as seen before, asset allocation should not be static, but reflects economic and market condition. So the theory versus the practice. I think what is crucial to understand here is we need to be flexible depending on economic and market conditions. Economic and market conditions will always change, or most of the time be changing, and will be different from one time to another. And this is fundamental for us as investors, as traders, to adapt to those new conditions. As seen in previous videos, like in video number 3, the economic cycle will greatly dictate our asset allocation. Here, 70% of the time, as we saw before, asset allocation will be dictated by economic factors, with the S&P 500 and the GDP moving in the same direction. But 30% of the time, they will be moving opposite. But still, economic factors like below GDP trend or fear of global slowdown, global effects on world GDP could be the reason. So always keep in mind about the 70-30%. On top of bonds and stocks, you need to incorporate other asset classes in your investment process. Obviously, as we covered before, the stock market is the biggest market for retail trader, with 3,000 stocks in the US, 1,000 stocks in Europe, but still, from time to time, you will see opportunities coming from other asset classes. So it is fair to say that the more capital you have, obviously the easier the diversification will be. In practice, what we need to remember as well is the roles played by central bankers since the great financial crisis. And these roles could impact future returns of different asset classes. Central bankers have always been a big part of financial markets, but their roles have increased drastically since 2008-2009. So as asset prices have been recently distorted by those central banks' interventions, that requires extra care from us. As we have an absolute mandate, cash, as we'll see later, is sometimes more than an option. That means at the end of the day, you don't have to always be invested. What about the asset expected return? To evaluate a potential investment in one asset, we need to calculate its expected return. So the formula of an expected return asset is the return expectation scenario number 1 times the probability scenario number 1, plus the return expectation scenario number 2 times the probability scenario number 2, plus, with n the possible scenarios. It is pointless to be targeting percentage of an asset if historical returns are very different, and this is what we're going to see next. Here we need to be extremely factual. Let's carry on with the example of asset expected return through the S&P 500 with 3 different scenarios. In scenario number 1, to which we give 25% chances of it to happen, the expected return will be plus 15%. In scenario number 2, with 25 chances of it to happen, the expected return will be down 30%. Finally, in the scenario number 3, where we give 50% chance of it to happen, the expected return will be plus 1%. As we've seen before in the previous slide, the total return expected will be scenario number 1, chances times the return, same for scenario number 2, and same from scenario number 3. And you end up here with a negative return of 3.25%. The meaning of this is it's pointless to be targeting return of an asset if historical returns are very different. What we need to do is to be very factual. To do that, we need to look at any possible trade that we'll be putting on with looking at the probability of the worst case situation, which would be here, the scenario number 2. with the asset being down 30%. Then, looking at the neutral situation, which is the scenario number 3. Finally, the best case situation, which will be 15%. The bottom line of this example is probably first that we need to be short this asset, but more importantly, that we need to look at the possible scenarios with their expected returns for each stock asset that we'll be putting a trade on. So analyzing historical returns is fundamental. First, to make sure that our expectations are realistic, we need to look first at historical returns. Secondly, based on its historical returns, we could have a first filtering on which mandate to follow. Those historical returns will help us in gauging allocation per asset class, the possible volatility, which size, which concentration to dedicate to all of our assets, and as well the geographical location. Historical volatility or non-volatility comes from the asset historical price changes. Expected returns on an asset equals the expected value of the probability distribution of possible returns. So here, the bottom line of looking at analyzing historical returns, we will have to look at the distribution of return. Historical returns. The calculation here is based on past performance, on historical data. Make no mistake, by knowing historical returns will give us future returns. There is no guaranteed. So if you look at different websites, if you look at a fund brochure, if you are buying an asset, you will have the following disclaimer. Please remember that past performance may not be indicative of future results. Nonetheless, historical returns are a good indicator of what happened in the past, based on certain conditions, and hence what could happen in the future. So what you will see, looking at historical returns, is how an asset has been behaving during different economic conditions or during different market conditions. Later in the process, we will look at implied volatility, which will tell us how market participants are pricing future returns based on different probabilities. Historical volatility, at the end, is the annualized standard deviation of past asset price movements. It measures the daily changes in the stock over the past year. So the historical return distribution is the most common return distribution, and it is known as the normal distribution. It is the most important and most widely used distribution in statistics, and it is known, as we will see the chart later, as the bell curve. It has two parameters, the mean and the standard deviation, and some others that we'll see later, but those two are the most important. The mean will show the center of the graph, the standard deviation, how high and wide distributions are. A normal distribution is symmetric around the mean, meaning it has a skewness of 0. The mean, the median, and the mode of a normal distribution are equal. And what it will be very important for the risk management and for possible expected moves, in a normal return distribution, roughly 68% of returns fall within one standard deviation of the mean, 95% of returns fall within 2 standard deviations of the mean, and 99.74% of returns fall within 3 standard deviations of the mean. So please take some time and look at this page, and especially the bottom of this page, because it's very important in terms of odds when we will be looking at returns. So this is the chart of a normal return distribution. So here, the mean is at 0, and as you can see, the data are mirroring perfectly on the 0. So the shape is a bell curve with the tails being the same on the left hand and the right hand. So what is the reality versus following a normal distribution? In that sense, the great financial crisis that we had in 2008 and 2009, empirical studies show that distribution of returns rarely follow a normal distribution. So a normal distribution is very academic, but in practice far from being the reality. So more returns might be around the mean than a normal distribution, i.e. being more picked. In reality, more returns with large deviation from the mean, meaning having fatter tails. That means the asset will experience more extreme large deviation from the mean than normal. The kurtosis is the statistical measure telling us when a distribution is more or less picked than a normal distribution. And here, let's take a bit technical, we will call a leptokurtic, meaning distribution, meaning it's more picked than normal, and platykurtic, less picked. Here, kurtosis measures the pickedness of a distribution and gives information about the probability of extreme outcomes. Positive kurtosis implies a distribution with more extreme possible data values, outliers, than a normal distribution, thus fatter tails. A follow-up on reality versus following normal distribution. Again, when returns do not follow a normal distribution, they will show kurtosis or skewness. We look at kurtosis in the previous slide. Skewness measures the degree of asymmetry of a distribution around its mean. A distribution is called asymmetric when one tail is longer than the other. A negative skewness implies a distribution skewed to the left, and a positive skewness implies a distribution skewed to the right. Obviously, a zero skewness suggests a perfectly symmetric distribution. The conclusion of this first part is returns following a normal distribution are very theoretical and hence very few do. To better understand the distribution of returns from an asset, skewness and kurtosis will be key. High volatility events like 2008-2009 showed how crucial they can be for outliers. But the same can be said for any asset or any particular time. As we've seen before, I think it was in video number 1, market will always face drawdown once or twice a year, between 10 to 20%. So we should be ready and be expecting those big moves. We should expect returns to follow normal distribution 85% of the time, but the outliers will be crucial in the overall performance in the long run. By understanding the shape of historical returns, we will be able to adjust our risk management. So in a sense, we need to be ready for the worst case situation, or the situation that happens, 5 to 15% of the time, and it's going to move big time. By measuring how its distribution differs from a normal distribution, skewness and kurtosis are great tools to figure out how reliable our expected returns are based on standard deviation and how they could be. Quickly looking at how to calculate those data on Excel. First, if you don't have the ribbon, you need to add it on your Excel if needed. So you need to go to File, Options, Add-ins, Analysis Toolpack, OK. The first thing, how to calculate data on Excel. That will be for the mean, standard deviation, and median. Here you need to select the data, data analysis, descriptive statistics. The input range will be the data studied. The output range will be the destination cell. And then you need to select summary statistics. To put in place intervals on Excel, first you need to create the intervals. Let's say from 0 to 1%, from 1 to 2%, 2 to 3%. Then you need to select your data, data analysis, histogram. Your input range will be the data. The bin range will be the intervals that will be created, and you need to select the cell destination in output range. The distribution of the S&P 500 index returns. Maybe some of you don't know what is the S&P, so very quickly, the S&P 500 is an American stock market index. It's based on the 5 largest US market capitalization of companies. It was created in 1923, but only in 1957 had 500 companies. Companies are selected by a committee on 8 criteria: the market cap, the liquidity, the domicile, the float, the sector, the financial viability, and the listing length. It is a price return index, and it is a benchmark for many market participants. So if you are working in industry, you will be looking at the S&P 500. Very few people in reality looks at the Dow. We will be looking here at the distribution of returns for different time frames, from intraday to 1 day, 1 week, 1 month, 6 months, and 1 year. So what about the intraday S&P 500 historical return? As you can see at the top right hand, the mean is roughly around 0%. And this calculation has been done on roughly 14,000 accounts. So if you were trading intraday, the close versus the open, let's say buying on the open and selling on the close, you will be making 0%. So after cost of trading, you will be losing money. So the bottom line of this is trading the S&P on an intraday basis, you will not be making any money. What about the 1-day S&P 500 historical return? First, let's look at the mean, which is very similar to the average return that we had on an intraday basis at roughly 0%. 47% of the time, return will be negative by 0.7%, and 53% of the time, it will be up by 0.67%. Let's look now at the curtices. So the curtices stands here at 20. The curtices of a normal distribution is at 3. So it is common to compare the curtices of a distribution to this value. As we've seen before, distribution with curtices with less than 3 are said to be plateaukurtic. Also, this does not imply that the distribution is flat-topped as sometimes reported. Rather, it means the distribution produces fewer and less extreme outliers than does the normal distribution. But here, in that case, with the curtices at 20, that means the average return for the S&P on a 1-day basis will produce more outliers than does the normal distribution. What about now the 1-week S&P 500 historical return? Now the mean is at 0.12%, which is still very close to 0%, meaning that if you were buying and holding the S&P for 1 week, from 1 week to another, after cost of trading, you will not be making money. 44% of the time, the S&P will be down by 1.5%, and 55% of the time, it will be up by 1.4%. Let's look now at the skewness, which is the measure of the asymmetry of the probability distribution of a real value random variable around its mean. Here, the skewness is negative by 0.5, meaning a negative skewness commonly indicates that the tail is on the left side of the distribution, which will be here, and positive skew indicates that the tail is on the right. Clearly, here, for 1 week holding, the tail is on the left. What about the 1 month S&P 500 historical return? Here, first thing to see is returns are going up, 0.6%. The curtices is very close to the normal distribution, and the skewness is on the left hand. On 6 months, now the mean or the average is around 4%, meaning that if you were holding the S&P for 6 months, you will get on average 4% return. 30% of the time the S&P will be down, and 70% of the time the S&P will be up. And those data are from 1962 to 2019, so going through different market conditions and different economic cycle. Here the kurtosis is at 1.3, which is below the 3, which means that the returns are following a plutocratic distribution, meaning the distribution produces fewer and less extreme outliers than does the normal distribution. And the skewness here, as you see, is very close to 0. What about the 1-year S&P 500 historical return now? Average return now is 8%. 25% of the time it will be down, 75% of the time it'll be up. Then the kurtosis is way below the 3, and the skewness is negative. So what you have here, the outliers will happen less often than a normal distribution, as the kurtosis is at 0.5. And what is important for the return is by doubling holding period here from 6 months to 12 months, you'll be doubling average return. So the bottom line looking at the S&P 500 is, if you are looking at making money, let's say 8%, you'll have to hold the S&P for roughly 1 year. Let's look now at a single stock name, and we're going to look at Microsoft returns. So Microsoft was IPO'd on March the 13th, 1986. Below you have the definition of Microsoft, but I'm pretty sure you're familiar with the company. The market cap is roughly 1 trillion at the end of May 2019. They have 131,000 employees, and it's listed on the Nasdaq stock market, and it's part, as we see at the bottom of this slide, of many indexes in the US and in the world. So this is the chart of the different time frame and returns and distribution going from intraday to 1 year. Here, after 6 months and 12 months, as you see now, the probability is to make on 12 months 31%. Whereas if you were holding Microsoft up to 1 week, you will not be making much money. Here, the distribution for the 6 months and the 12 months with the kurtosis of 10 and 7 and skewness of 2 and 2 means two things: that they are producing more outliers than a normal distribution, and your distribution is towards the right hand, so more positive outcomes than negative outcomes. So since the IPO, Microsoft, let's look at the percentage of positive returns on different time frames. More or less, most of the time, from 67% to 75% here, Microsoft will be positive from 1 day to 1 year. And the average return, if you are holding Microsoft on a 1 day to 1 week, as we've seen before, will be close to 0% and up to 32%-ish after 1 year. So let's look now at another asset classes through the distribution of bond returns. Here I picked the ETF AGG, which stands for iShares Core US Aggregate Bond ETF. You can find the link below to get the data from Yahoo Finance. AGG tracks an index of US investment grade bonds. So the market weighted index includes treasuries, agencies, CMBS, ABS, and investment grade corporates. And it's a big ETF with 61 billion of assets under management at the end of March 2019. And at the bottom of this slide, you can see the different holdings of this ETF. So let's look now at the historical returns the way we have done for Microsoft and the S&P 500. Here, the kurtosis for 6 months and 1 year is important at 0.5, which is way below the 3, telling you that the outliers, there will be less outliers than a normal distribution, and these outliers or the returns will be on the right hand. But what is more important for us looking at the historical returns is you should not be expecting to be making any money up to 6 months. In fact, if you were holding AGG ETF for less than 1 month, your best return on average will be 0.3%. So if you take the assumption that you'll have to pay 0.1% as an entry with as commission, and the same when you're exiting the position, that makes roughly 0.2% cost of trading. So on the 1 month, average return will have been 0.3% minus the cost of trading, which is 0.2%, you will end up with 0.1%. So overall, as we see here, if you were holding AGG for a year, you will have been making 3.7%, which is obviously far away from the 30% of Microsoft and more than half less than the S&P 500. So let's look now at another asset class through the euro-dollar return over 1 month. So over 1 month, you can see that the number of down days are bigger than the number of up days. Not by much, but still. And overall, if you were holding the euro-dollar for a month, your average return would have been 0%. Then it's not on this table, but the courtesy is 1.15 and the skewness 0.1. So that means there will be less outliers than a normal distribution. What about now about the distribution of WTI or crude oil over 1 year? So over 1 year, the mean stands at 7%, which is not far from the 8.5% from the S&P 500. Roughly 55% of the time, it will be up, and 45% of the time, it will be down. As you can see, when it's up, the returns are much bigger than when it's down, by roughly 30%. Here, the courtesy is at 1.2, so that means less than normal, and means the distribution produces fewer and less extreme outliers than does the normal distribution. Plus, the skewness is at 0.71, indicating that the tail is on the right. The conclusion of this video is empirical studies show that distribution of returns rarely follow a normal distribution. We have done that across asset classes and across different time frame. Instead, the distribution usually has fat tails owing to the increased probability of unusual events occurring. In that sense, to better understand the distribution of return for an asset, we need to take into consideration the mean, the standard deviation, the courtesies, and its skewness. It does not have to be extremely complicated, but trying to figure out what were the odds in the past. Then we will have to look at how the asset performed during different phases. As we have seen before, when you look from 1962 to 2019, there have been many different market conditions, many different economic conditions where the GDP has been moving from -2% to +5%. So what is key is picking these different time frame or moments in the past that happened and trying to see what were the returns of our assets during those times. Then, going through historical distribution of returns, we can now better allocate capital across asset classes and over different time frames. The easiest way to understand market return is to go from top to bottom, i.e. from index to single names. So I strongly suggest you to first look at the stock indexes like the S&P 500, the Nasdaq 100, the Euro stocks, the stock 600, looking at the big historical returns. doing the same, for instance, for ETF, then scroll down into single names. And you could do exactly the same across asset classes for FX, bonds, and commodities. So what we've done in these videos is we have looked at historical returns. Now, what we must do is confront these historical returns to market expectation, meaning the implied volatility.